The topic today is IRAs. Now that doesn't stand for Irish Republican Army, but it does stand for Individual Retirement Account. And roughly 45 million Americans have IRAs, and chances are you're one of them. Hello, I'm Dr. Shelby Smith of the Retirement Pros, and my objective is to explore IRAs and help you have a worry-free retirement, plus leave a better legacy for your loved ones. So please sit back, relax, open your mind. We'll try to cover the IRAs in less than 15 minutes. What is an IRA and how do you get one? Well, there are two basic types. The first we call the traditional IRA, and this allows you to contribute annually. That is, if you're working. The contributions amount is linked to inflation and changes annually. The contributions are before taxes, meaning the money put into your IRA is not counted as taxable income and not taxed until the IRA money is actually withdrawn, generally in retirement. Until withdrawn, the money grows tax deferred, meaning no taxes are paid on the earnings. So that's the traditional IRA. The next type is the Roth IRA, and is exactly like the traditional IRA with one major exception. Your contributions are after tax, meaning the amount you put into the Roth is counted as taxable income, and withdrawals are tax-free. You can split your annual contribution between traditional and Roth, but combined you cannot exceed the total contribution limit. If you have an IRA, you got one in three ways. One, you started an IRA and made contributions to it. Secondly, you roll money from another retirement plan into an IRA. Or lastly, you inherited an IRA. IRA money may be invested in a wide variety of things, but most people opt for conservative places because this is their retirement money and they will not take a lot of risk with it. What about transferring money from another retirement plan into an IRA? You can do this at any time provided the retirement plan where the money is now permits the transfer. The most common place from which you would transfer are 401k plans and 403b plans, which are retirement plans for school teachers and certain nonprofit employees. Now, here is something you need to hear loud and clear. Money at an ex-employer should be transferred immediately. There are many reasons, including as an ex-employee, employer contributions have stopped, so there's no matching. You're paying fees and other expenses that can be avoided if you move your money to an IRA. If you died, your spouse or beneficiaries could be paid a lump sum, which means they'll have a large and unnecessary tax liability. If no beneficiary is named, your estate could get taxed twice on the same money. Once, you would pay income tax, and second, you would pay estate taxes. If the company failed, your retirement money could be in jeopardy. Think about what happened at Enron. So transferring to a traditional or Roth IRA can be done very quickly without cost or hassle, but I recommend you get your help from a financial advisor. If you have money with an ex-employer, you need to move it now. No exceptions. It's easy to move into an IRA, and there are a lot of really good reasons for that, which we discussed. What is the stretch IRA and how does it work? First of all IRAs have a named beneficiary, whether they're traditional or Roth. So be sure and check to make sure yours does. You can name any beneficiary you want: spouse, child, grandchild, church, charity, friend, or whomever. If the spouse is your beneficiary, your IRA transfers to them at your death and would be treated as if they had owned it from day one. At your death, a non-spouse beneficiary is allowed to take the money from your IRA over their remaining lifetime. The formula is very simple. how much is in the IRA divided by their remaining life expectancy. For example, let's say you have $100,000 in your IRA and your beneficiary is your 10-year-old grandchild, and they're expected to live another 75 years. They would then have to take 1/75th of $100,000, or a little over 1%, in year one. The next year, they'd take 1/74th, and so on as they age. Since the withdrawal rate in the early years could be less than the earnings rate, the IRA may continue to grow for many years, and as it does, the annual withdrawals will increase. As you can see, the younger the beneficiary, the longer and greater will be your legacy. What happens if the person who inherited your IRA dies prematurely? Well, their beneficiary can continue to take the same payments the deceased beneficiary was getting until all the money has been withdrawn. If the IRA was a Roth, all withdrawals will be tax-free. What a gift to leave as your legacy. Why might you want to convert to a Roth IRA? Well, there are several reasons, but here are the principal ones. When money is withdrawn by you, your surviving spouse, or a non-spouse beneficiary, there are no income taxes, not even on the earnings. If a Roth grows from $100,000 to $500,000, there will be zero taxes on the growth. So how sweet is that? Secondly, Roth IRAs have no required minimum distributions. You don't have to start withdrawing money at 70 and a half or at any time during your lifetime. So if no RMDs are important, Roth is the answer. No RMDs means a Roth can also double as emergency money. Next, if you're now paying taxes on your Social Security benefits, converting to a Roth might lower your tax bill. Another good reason, which way do you suppose taxes are headed? If you said higher, I'd agree with you. So why not pay the taxes on your IRA now by converting to a Roth? If you don't know for sure which way taxes are headed, just convert some of your retirement money to a Roth IRA. The only disadvantage to a Roth is that you must pay taxes on the amount converted, but you can control taxes by converting over several years. You'll want to discuss this with your financial or tax advisor. Roth IRAs are not for everyone, but if you're concerned about taxes going higher, tired of taking RMDs you don't need, or want to leave a tax-free legacy for your loved ones, converting your traditional IRA to a Roth could be the answer, and you need to investigate it. What about the RMDs? That's the required minimum distributions you must take from traditional IRAs. If you don't need the money for your retirement, you have several good options. If you're medically qualified, you can use the RMDs to purchase a long-term care insurance policy. Long-term convalescent care is something that a majority of retirees will need, especially the gender that lives the longest, and that's you, ladies. The best strategy for long-term care coverage is to select an annuity or life policy that has a long-term care rider. This avoids the use it or lose it problem. So ask your financial advisor about the details of using RMDs to purchase long-term care. Secondly, if you think future taxes will rise, why not use the RMDs to pay the taxes on converting to Roth IRA? An added benefit could be lower taxes on your Social Security benefits. If uninsurable, you could use the unneeded RMDs. If insurable, you could use the unneeded RMDs to purchase life insurance that will provide your heirs or your church or your favorite charity a tax-free legacy. By the way, you don't have to be in perfect health to qualify for life insurance. You could also use the unneeded RMDs to establish a college fund for your grandchildren, a home down payment fund, or pay for other future needs. You can even buy a life insurance policy that delivers to your grandchildren or your children a birthday check for the rest of their life. Now that's a legacy that will keep your name in circulation long after you're gone. Of course, there are other important things about IRAs, but hopefully I've given you a basic foundation about what you can and cannot do. So here are the things to remember. One, if you have retirement money at an ex-employer, you need to move it to an IRA immediately, either a Roth or a traditional IRA. Your financial advisor can help you. Two, the stretch IRA is for the next generation, and you must have a named beneficiary for it to work. Three, the Roth IRA is an excellent way to reduce future taxes. Leave a tax-free legacy and lower taxes on your Social Security benefits. And finally, if you're taking required minimum distributions not needed for retirement, there are several excellent ways you can use them to benefit you and or your heirs. I sincerely hope you are leaving with some good ideas. Remember, one of the biggest mistakes most retirees make is trying to solve financial and tax puzzles without the help of a professional. I hope you will find and work with a financial advisor. Thanks for your time. Have a great day and an even better tomorrow.